First things first, we're going to be talking about the Federal Reserve raising the interest rates a quarter of a point. Of course, this is the lowest since, the recession kind of started, or I suppose like the recession that's not referred to as a recession, the economic downturn that's not an economic downturn, according to whoever's in charge of the government at the time. However you want to slice that cookie, whatever. It's the lowest since this whole debacle began. But the Federal Reserve met today and announced yet another hike, raising interest rates a quarter point. The meeting saw the Fed execute its lowest interest rate hike since March of last year, slowing down its aggressive tightening over the course of 2022. Fed Chair Jerome Powell was expected to slow hikes at today's meeting as it maintains vigilance against inflation. Still, the reduction in the size of the hike marks a welcome change to the consistent increases that have been the norm. So following a 0.5% point hike in December, the Federal Reserve has raised interest rates a quarter point today. The decision marks a noticeable slowdown in the Fed's battle against inflation and is their smallest increase in almost a year. Prior to the announcement, CNBC noted that the meeting was expected to be relatively uneventful, but would challenge Powell's ability to temper expectations. The markets have been rising as investors expect the central bank might succeed in a soft landing for the economy while also snuffing out inflation sufficiently to move back to easing policy. Today's 0.25% interest rate hikes represented the Fed's eighth increase since March. Moreover, it puts the Fed fund target range at 4.5% to 4.75%, a mere half percentage point off from the terminal rate range of 5% to 5.25%. Still, if the market reaction sparks a rise that is too quick, it could have a counterintuitive effect on the Federal Reserve's actions to combat inflation. Following the start of the Federal Reserve two-day meeting on Tuesday, stocks rallied. Overall, the technology sector was up 9% for the month, with rates falling since the start of 2023. Moreover, CNBC noted that the 10-year Treasury yield stands at around 3.5%, following a 3.9% mark at the end of December. So, obviously, rates going up. The big news here, like we were talking about on the Bitcoin price could reach 45K by Christmas. I don't think this is accurate, and I would say that it probably won't. In fact, I have very, very low confidence in this. If this were to happen, we would break the halving cycle pretty heftily, which means we would go into basically a potentially a possibility of a super cycle, which I suppose could be, but history tells me that this is just, high hopes. There is one factor that may play into this that I would say would be outside of my sight, right? Which would be energy prices, right? So as we know, with cryptocurrency, with Bitcoin mining in particular, the price to mint a Bitcoin does influence the price that Bitcoin is, right? And that could end up with a huge increase, the huge increases we see in the price of energy influencing the price of Bitcoin to go higher. Could it be double, 200% as far as the price to mint a Bitcoin over what it is currently over the year? I guess potentially, but then economically, we're going to be suffering pretty heftily on the energy front. So a $45,000 Bitcoin isn't going to sound that good when your energy prices have gone up 200 to 300% for the second year in a row, right? Like it's just not going to be a good report, right? Other than that, if that is not the case and energy does not flow in that manner of increasing in cost that much, but the price of Bitcoin goes up and we outside of the traditional halving cycle of Bitcoin, then I would say, okay, at this point, well, maybe we've broken out of the traditional halving cycle. When Bitcoin's performance is positive in January is their argument, the rally tends to continue through the end of the year, the report said. U.S. institutions have probably been behind January's rally in Bitcoin when the cryptocurrency gained more than 38%. and outperformance this early in the year tends to be bullish for the token's price. Crypto services provider Matrixport said in a research report Wednesday. In 5 of the 6 years that Bitcoin has rallied in January, the cryptocurrency has ended the year with positive returns. On average, the gain the rest of the year has been more than 245%, wrote Marcus Thielen, head of research. The only year when Bitcoin declined after a strong January was 2014. That's only 2 cycles. I mean, this report's stupid. Sorry. I just, I can't. The only year that this didn't happen was in 2014. It was because 2014 was on the halving cycle. It was influenced by that. So we're more akin to right now repeating the halving cycle of 2014, I suppose, than the one of 2018. Sure. But their arguments are unfounded, really don't hold any water at all, especially if you compare it to 2014, which is the only other time it didn't go up if it went up in January. Is like saying, oh, but really the halving cycle is correct and we're wrong. If they understood anything about Bitcoin.
Established in 2017, Octominer is an international mining hardware company. They manufacture and engineer the best mining equipment in the industry and supply rigs to some of the largest mining farms around the world. Their GPU mining rigs also integrate with the top crypto operating systems like HiveOS, MinerStat, and Simple Mining. All parts come with an international 1-year warranty. Exciting news! They will be adding ASIC miners for sale to their website soon and launching a new product built specifically for ASIC home miners. Please visit octominer.com or email support@octominer.com for questions.
JP Morgan says biggest risk to the market in 2023 is no recession at all. So basically, it's not going to happen. You know what I mean? Markets Insider reported JP Morgan strategist Mike Bell stating that the biggest risk to the market in 2023 is if there is no recession after all. As the economy has feared a recessionary state in the U.S., the actions of the Federal Reserve could negatively impact how the economy reacts. Bell has stated that without a recession, current wage growth could force the Fed to raise rates more than expected. The action would be an attempt to combat inflation, which would lead both stocks and bonds to decline without rate cuts. The current economic state of the United States is certainly a fragile one. Many are fearing for the worst and preparing for such, as the economy reels following Federal Reserve interest rate hikes throughout 2022. Yet JP Morgan strategist Mike Bell has stated that the greatest danger to the market in 2023 is no recession at all. Bell's statements are rooted in a reality of possibly forcing the Fed to remain hawkish. The Fed has been raising interest rates since March of 2022, leading many to brace for a recession, as abundant data shows prices cooling off as the tight monetary policy slows the economy. Conversely, S&P 500 and the Nasdaq are all up. Subsequently, the Fed will begin reversing its tightening campaign in response to an economic downturn. Yet, Bell believes that if the U.S. economy avoids a recession and wage growth remains high, then the Fed would not cut rates as expected and instead would have to resume rate hikes in the second half of the year, he told Bloomberg TV. Additionally, stating, unfortunately, at that point, you're back into a world where both bonds and stocks would go down together. JP Morgan's best case assumes a recessionary action in 2023, allowing wage pressures to moderate and the Fed to cut rates in 2024, according to Bell. Specifically noting, my best guess is that the Fed is going to bring rates down to about 2.5% by the end of 2024. It means we'd have 2 years, of course, give or take, right? From this point forward, we got interest rates back down, but we haven't even started bringing interest rates back down, right? So that's the influence of, like we were talking about earlier, the 0.25% as opposed to 0% or going in the reverse direction. We haven't even started reversing that at this point. Now, as far as the statements of not going into a recession at all, I I hear what they're saying, and as far as like, what Mike Bell has to say here, I tend to say that I don't know near as much as anybody else on the economy, so I tend to listen. However, I'm not necessarily sure that it's well, how do we put this? So a risk to the market does not mean a risk to the general public. Meaning, as you can tell, when they start talking specifically about wages, is where this really comes in. Meaning, I think the reason the recession would hit the market is that, or would hurt the market, or not going into recession would hurt the market, would mean that wage pressures would be rising to a rate to where you're hurting the actual companies to a certain extent, but the day-to-day life of the individuals working for those companies would tend to be better. Meaning, the way I read this is, the biggest risk to the market in 2023 is no recession at all, but the biggest risk to the individual is a recession. I'd like to hear your thoughts and opinions, of course, in the comment section below. Thanks for checking out this clip from the Crypto Mining Show. You can check out the full episode here or more crypto content down here. Also, I'd like you to check out my locals page at sonofatech.locals.com, where you can become a member for free or choose to be a $5 a month supporter that unlocks additional content.